All right. Hey, guys, this is Toby Mathis, and today we're going to go over things that you just don't do during a housing bubble. Obviously, we don't even know if we're in a bubble, but we're definitely going to see the Fed raising interest rates. They're going to continue to do so. If anything, what we're seeing is probably the middle of it. It should go through the end of the year and then into early next year, where we're probably going to see interest rates. Now, the bubble kind of implies that all of a sudden there's just going to be like this no demand and we're going to have this massive issue. There's plenty of demand for real estate. In fact, we're underbuilt in this country by some 3 million units, depending on who you listen to. And if you just use your eyeballs, you can see it's really tough for people to find affordable housing. But that's not necessarily what we're talking about. What we're talking about is the housing market as a whole and the economy as a whole and your ability to get in and out of real estate. And so kind of specifically for investors, and here I'm just going to pull up a white screen so that I can keep a list of all the fun stuff that we're going to cover today. But if you're an investor, if you're a cash flow investor, it's one thing. If you're a flipper, it's another, right? So if you're somebody who's trying to take advantage of short-term swings in the market, then this is really something you need to be paying attention to. If you're somebody who's the tried and true, you kind of follow our infinity method and you're doing cash flow, then this is going to be no different for you. Like, this is just going to be great. There's going to be plenty of opportunities abounding. And so I'm just going to go through these, and I'll share a screen out so you can actually see it, and I'll put myself up in the corner so you can see me. There we go. And let's just kind of do a quick rundown. So number one, and I just mentioned it, but don't flip. Don't flip. And I'm just going to say things not to do in bubbles. Right? So we're just going to say things not to do in bubbles, and move that over. Number one, big number one. Oops, don't flip. There we go. Don't flip your real estate. This is where people get caught all the time. In 2008, I just remember a ton of flippers getting stuck with their properties. And what I'll do is I'll put a kind of a cross on here. Don't hard money lend. Don't hard money lend on flips, right? Just get away from flips for a little while. And the reason being is because the market tends to, if it starts going downward, time's not your friend. All of a sudden, time's your enemy. Every day you own a property and you're holding it, it's becoming worth less. If you're in an increasing market, then you could screw up a flip. You could make a bunch of errors in judgment, end up holding it for 3 months longer than you anticipate. And it actually works in your favor because it's appreciated and you look like a genius. But right now, that is not something you want to be playing around with, because as interest rates go up, affordability goes down, and less people are going to be entering the market to buy your beautiful flip, especially if you're selling to first-time home buyers. Right now, affordability is a major factor. Stats came out last week showing that the median house price and the price for the mortgage would cover and eat up about 42.5% of one's income, meaning that housing is very unaffordable. Typically, you're looking around 30% is what they're kind of shooting for when you're looking at the cost. And that's just the cost of the debt. We're not even talking about repairs and things like that, maintaining a house. We're talking about, more than 40% just right out the gate. So like there's just, we're having an affordability issue. And with interest rates going up, that number's going to go up. So all of a sudden, the people that you sell to aren't going to be able to afford your home. But by the way, where are they going to go? They still need a place to live. They're going to be excellent tenants. So if you're a landlord, this is your favorite time. Number two, do not do adjustable rates. Interest rates are rising. We don't know how high. They've gone up. They've doubled this year. Just mortgage rates. I think we were at 6.8% today. I still remember when it was 2. It's like, it's gone up like a rocket ship, right? So you're looking at this thing going, where is it going to end? We don't know. The Fed, the last session when they increased interest rates by the 75 basis points, was a unanimous decision. It looks like they're probably going to do it at least a couple more times this year, depending on when you listen to this. It just means that in 2022, interest rates are going to continue to rise, which is going to create affordability issues for first-time home buyers especially, but just home buyers in general, which means that there's going to be people sitting on the sidelines. If they're forced to buy a house, like if they're forced to move, they're doing it. If they're not forced to, they're probably waiting for this thing to correct, and for everything to work itself out. It might be 6 months, it might be a year, it might be 2 years. Nobody has that crystal ball. So you need to be able to float in the middle. You need to be able to weather the storm, so to speak. And with an adjustable rate, all of a sudden your affordability can go from okay to bad to worse. And it's just a matter of time. That adjustable rate is what caused so much pain and suffering during the Great Recession between 08 and 10. And it can just cause issues. So number one, don't flip. Don't loan money to flippers because they might get stuck with a property that won't cash flow with these high interest rates. They're not going to be able to pay it. You're going to end up with the real estate if you're the lender. Unless you're a hard money lender that loves to own the real estate, but that's typically not part of the calculation. That's not what they want to be doing. They want to be making their money on loaning and making a decent interest rate. So anyway, so don't do that. And then don't get adjustable rates. Number 3 would be don't buy an expensive home. Not right now. I say that like if you have to, like every market's a little bit different. So if you see a great deal, you come along and you buy it. But right now, we haven't had this price in. So there could be a correction. It could be that we were in a rocket ship of a rise and now we're leveling out. It doesn't mean that we're falling out of the sky, that we're doing a crash. It could be that we're the 777 and we're at 35,000 feet. We got up there quick. It was like leaving the John Wayne Airport where they just go straight up. And then you're leveling out. It could be. Or it could be that we're having a slight decline. Whatever the case, we don't know. What we do know is that interest rates are going up really high and affordability becomes an issue. And if you're buying something now, like if you're going to buy an expensive home, buy it with cash. And don't expect that, and don't have to sell it. Like this is a forever home, fine. But if it's a house that you intend to, hey, you know what, I really just want a house and I'm going to be stretching to get it, man, even if you do a fixed rate, you're paying a really high amount right now. I don't know if I'd be doing that. So this is one of those markets where the high end of the market tends to get pushed down a bit. So the moderate end in the housing, like the typical cash flow real estate, always has a market. So even through the recession, the Great Depression, even all that pain and suffering, there was still a great rental market because people had to have a place to live. If you're in a house that would not rent, and I use the rule of 5%, if I can rent a house for 5% or less of its value, then I'm better off as a tenant. So you can flip that around as the landlord. You better be making more than 5%. And if you can't, then it's probably not something you want to be doing. And even right now, I'd probably be adjusting that upwards because that 5% is based off of the interest rates being in the 3 or 4% range. So you could actually say, hey, at 7%, 8%, just make sure that I can cash flow if I need to on this house. Make sure that if I have to rent it, it's not costing me money. So that if you end up in a situation where you're forced to move or you have a life constant, something bad happens in your world and you cannot keep that house, you got to get into a situation where you could rent it and you're not forced to sell in this market. Because if you're going to be forced to sell, right now affordability is not there. Interest rates are really high, so people aren't buying. So the inventory is going to start piling up, which is going to cause prices to either slow the heck down, like we've been seeing these astronomical growth rates over the last few years. It'll either slow that way down or it's going to cause the prices to go down. And if the price goes down and you're forced to sell, it sucks. So, don't be buying expensive houses that, unless it's your forever home and you're buying it with cash. Don't do that. What you also don't want to do is be doing a bunch of rehabs and adding value. And there's 2 reasons for that. Number 1 is affordability is a factor. And when affordability is a factor, a lot of times you won't be getting back your money if you're forced to sell. So if this is a situation where in any circumstance you might be forced to sell, you don't want to do this. If you are a cash flow landlord, this does not apply to you. If you're a cash flow landlord, adding value is based off of a formula to see what your cap rate is. And you could say, hey, you know what? If I add $10,000 of improvements to this house, it's going to yield me an additional $300 or $400 a month. Of course, I'm going to do that. I'm going to do that all day long, right? But if this is a house, so you're just like, oh, I just really want to improve this, and I might sell next year, whatever. Don't expect affordability to come back anytime soon. It's going to be a while. So there's a good chance that that's just going to be throwaway money. If you're a flipper, this also applies to you. You might want to be just getting that thing sold because the debt you have, if you're doing a typical flip and you have short-term debt and you're paying a higher interest rate, that's going to kill you. Seen that happen over and over and over again. So you want to make sure that you're not in a situation where you're paying a high interest rate, especially if it's adjustable, especially if you have penalties, because you're not able to sell it in time. Because a lot of those short-term loans, obviously they have escalation clauses if you don't sell it right away. And if you're stuck with this house, hey, I have a great house, beautiful house. It's worth every dollar that's in it, but nobody can afford it because there's no loans out there. They can't get the loans. And by the way, mortgage applications are down. I heard that this morning was like 85% year over year. So people aren't looking for 6.8% money. I'm sorry. You're going to end up sitting on a house. So you got to be able to cash flow it. And so if you're in the middle of a rehab and you're trying to make something, hey, I need to make this house worth more so I can sell it, you might want to look at it and say, I just need to sell it. I need to dump it. If you're going to take a loss, it's kind of like getting, one punch versus a whole bunch of, paper cuts. It's like sometimes it's better just to take your medicine all in one dose, right? So if that's the situation you're in, let's just get rid of that house and let's not put more money into it and exacerbate the issue. And then the last thing is do not pay off, do not pay off low to no interest debt. And here's why. Right now, a savings account might get you 2-3% if you're really lucky. Like that's really high. They're going, oh my God, this is historical. This is so high. Well, it's not historical highs, but in the last few years, there we go. This is way better, right? Oh my gosh, we were at 0.2, like we were at a quarter point. You're getting almost nothing, and now you're getting 2%. Yeah, but inflation's 8%. So you're losing 6% every year. So if you flip that around, if you have low interest debt and you could be using your dollars to pay it off, your debt is less than inflation. You're actually in a net positive route. Now, what do you do with those dollars? You put them on the sideline. You get ready to take care of opportunities. If you're smart, you're buying through this whole thing. And when I say you're buying through this whole thing, you're buying investment properties that are cash flow properties and you're watching the market. There's no way to time it. So you let the numbers dictate whether something's a good deal and you just keep looking. There's going to be people that might be in a situation where they need to sell. They have to sell. They're forced to sell. There's probates out there. People pass away. They're still getting rid of properties. There's people that are investors that are upside down and don't have good loans. And you're like looking at it saying, I could buy it cash and I have a nice 7 cap, 8 cap property. Maybe their loan's 10%. So they're negative cash flow, or maybe their loan is 8% and they're losing money every month. And they're just like, I just want to dump it. Fantastic opportunities for me. But guess what I need in order to take advantage of that opportunity? I need the cash. If you have a 2 or 3%, let's say you have a 3% interest loan on your house, it's 30-year fix. I wouldn't go paying that off. And I'm usually a no debt guy, right? I hate having personal debt. So I don't have personal debt on my house. I just don't do it. But if I could, this is one of those cases where if I had 3% and I'm either looking at paying it off or going out and taking advantage of some more opportunities, I'm probably taking advantage of more opportunities. I'm looking at it saying, hey, you know what? Inflation's rising faster than the interest rate on my loan. If I just had if I paid that off, I'm definitely getting a negative rate of return on it. So I want to use that money to create assets, to buy assets that'll go wipe out my debt easy. Because all of a sudden, if I have even a 6%, 7% return on a nice house, it's going to cover my mortgage payment. It's going to pay it off for me. So all of a sudden I'm like, hey, I buy an asset to pay my liability. which, by the way, is one of the tenets of Infinity Investing, a book I wrote. You can always get that on Amazon, Infinity Investing. Take a look, and it's a good community too. But you buy assets to pay for your liabilities. I never tell somebody, hey, you can't have a Lamborghini, or hey, don't buy these really nice things, don't buy a big house. I wouldn't say that. What I would say, and I know there's a lot of people out there that say, live off of nothing and, buy a really modest house, older cars and all that stuff. I get that. If you're in a financial peril in your savings, that's for you. But if you have assets that are generating income and that income is going to pay for the liability that you incur. So, hey, I have a Lamborghini, it's $3,000 a month, and I have 3 or 4 rental properties that kick that off. And I say these rental properties are for this car. Fantastic. Your tenants are paying for your car. That's fine. I'm okay with that. I just say you got to have the asset that pays off the liability. So the same is true if I have a house, whether it's a home loan or a loan on a rental property, it doesn't really matter to me. What matters is that you're not working to pay off that debt. So, hey, if I have debt that's low interest debt and I have the cash to go out and buy deals, like even now in the stock market's getting crushed. But there's great companies now at about 4% yields on their dividends that have had dividend growth for decades. In other words, these are companies that are strong companies, great free cash flow. They're profitable. They pay out, it's the 3Ms, Coca-Cola, it's Procter & Gamble, Johnson & Johnson, Altria's, Federal Realty Trust, all these different companies that have just been paying out forever. And you look at them and you think, that actually pays out more than my interest, right? Even on those, you could do it. It's kind of weird, but again, I would tend to focus on the real estate market because we know what those returns are consistently over the years, and cash flow doesn't lie. Like again, cash flow will tell you what your house is worth. Cash flow will pay your bills. Cash flow dictates. We don't sit there and do comps on real estate properties. We base the value based off of what it generates. So we don't care what the neighbor's worth. What we care about is, like in some effects you do. Like if you have a neighbor if I'm able to buy a house in a neighborhood, everything's selling for 300 and I could buy it for 100, that's a bonus. But what I'm looking at is how much rental income is being created, and that will tell me what the value of the home is based off its cap rate, which is what its capitalization rate, what it's returning to me. So I can figure out the price of a house. That's how investors buy. If I know what its net operating income is, and I have a decent cap rate, I could say this is what it's worth to me. It doesn't matter what it's worth to anybody else. This is what it's worth to me. I'll buy it for that. And you could buy it in good neighborhoods with low. Right now we have super low unemployment. The Fed may change that, but right now we're sitting at historic low unemployment, and we don't have much housing. So there's a strong demand still, even with all new home builds kind of coming to a halt. Lots of houses sitting on the market. End of the day, people need a place to live. Rental market's still hot. In one of the areas, Winston-Salem, where I have hundreds of properties, it went up 42.5% last year. That's what the rents raised. So I just look at what is it going to generate. And if I have a low interest debt, then as long as it's fixed, I'm good. If you have variable stuff, make it into a fixed. Even if you're paying a little bit, you don't want to have that sum certain, because it looks like they're still going to be going up at least for the next 6 months to a year. And hopefully I'm wrong, but it certainly looks that route, that we're looking at 2 more interest rate increases. And, really the mortgage rates are on the 10-year treasury. And we're seeing again, there's blood in the water in the market. We're seeing interest rates going up. We have a Fed who's saying we're going to kill inflation by killing the economy. Like we're going to cause higher unemployment. We're going to decrease demand, all that good stuff. And so what I would just say is buy cash flow assets. Don't pay off low interest debt. If you're forced to, then I really feel bad. Like I would be doing everything I could. If I had to leave from my work or something and I had a house and I had a 3% interest rate on it, I'm trying to make that into a rental. I'm doing everything I can to keep that 3% interest rate loan, because it's that's practically an asset in and of itself, even though technically it's a liability, but you're paying less than the rate of inflation. That's actually a really good thing, and it's desirable. So, there's ways to do subject tos and things like that if you have to sell, but I would be looking to keep that debt on there. Make it into a rental, please. Do something to try to keep from having to pay that off, and then keep your cash separate and make sure that we call it having your powder dry for great opportunities. whenever there's this type of volatility in the market and you see the market crashing and you hear about real estate bubbles and all that, there's going to be opportunities for you. You just got to be able to take advantage of them when they show up, because you never know when they're going to do, and it usually requires you to act quickly. And so when you see a great deal, you need to be able to just go out and execute on it. You don't want to be in a situation where you got to talk to your banker and it's going to take a month and 2 months and they're going to make you supply a gajillion documents. The deal's gone. There's too many cash buyers out there. So that's it. I would say that there's 5 things to avoid doing, like do not do, things not to do in the bubble. Don't flip. If you're a hard money lender, 2 flippers, don't do that. It's going to end up poorly. I bought a bunch of houses, by the way, during the when the Vegas market, I shouldn't say a bunch, but like more than one, less than a dozen. But it was houses from hard money lenders. One of my favorite houses that I have was from a hard money lender, and it was about 1/10 of the loan amount. So I still remember that. Hard money guys are like, get rid of this. I need to get my money back out there. So if you're a hard money lender doing flips, be prepared for some pain, because time is not your friend and affordability is not going in your direction. And there's a good chance that the houses aren't going to be worth, they might be sitting there for a while. We have really 5 things. Don't flip. Don't do adjustable rates. Don't buy that expensive house right now, unless you're going to do so in cash in a great community and it's your forever home. Don't do rehabs right now or add values to things unless you're a cash flow investor. And do not pay off that low interest rate debt. It's actually something that's really positive for you. That is it. If you like this, click that like button. If you want to see videos like this, a lot of times it's just asset protection and tax. Every now and again, we get into the markets. If you like this type of information, subscribe. And if you know anybody that could benefit from this, please share it. If you have comments, you can leave them as well. I love seeing the comments that are out there, and it gives us ideas on what to create as far as videos and what type of content to put out there in the future. So if you could do that for me, that'd be awesome as well. Thanks, guys.